A rapid montage of 2008 headlines, frantic trading floors, Lehman Brothers bankruptcy filing, followed by smooth shots of today's soaring stock market charts and bustling coffee shops. We are told a story about 2008, a story with a beginning, a terrifying middle, and an end. A crisis that was contained, fought, and won. But this story is a fiction. The earthquake of 2008 was never resolved. Its seismic energy was merely absorbed into the very foundations of our global system. For 17 years, we have lived inside an illusion, a stability manufactured by the largest financial experiment in history. Now, the facade is cracking. This is the story of why the 2008 crisis never actually ended. Context, stakes, and historical rewind, archival footage of the Great Depression, then Nixon on TV in 1971, transitioning to graphs showing the explosion of global debt post-1971. To understand our present, we must rewind to the last great fracture. For centuries, money was anchored to gold, a system that imposed discipline but was brutally rigid. After World War II, a new order emerged. The US dollar, backed by gold, became the world's reserve currency. But in 1971, President Nixon severed that final link to gold. The era of pure fiat money began, currency backed by nothing but government promise and collective faith. This was the true Big Bang. Central banks were freed from their golden shackles. They could now create money to fight recessions and fuel growth. This power paved the way for decades of credit expansion, building a mountain of debt upon a foundation of trust. The stage was set not for a one-time crash, but for a perpetual cycle. The mechanism, how 2008 became permanent. Animated breakdown of mortgage-backed securities collapsing. Then a clear graphical shift showing debt moving from household to government balance sheets. In 2008, the bubble in housing debt burst, threatening to collapse the global banking system. The response was historic and fateful. Governments and central banks enacted a fundamental bargain. They would socialize the catastrophic losses to save the system. The mechanism was quantitative easing. Federal Reserve and its counterparts didn't just lower rates, they became colossal buyers, creating new money to purchase trillions in toxic assets and government bonds. This achieved two profound things. First, it transferred the crushing weight of private debt onto the public ledger. Second, it artificially suppressed interest rates to zero for over a decade. This created a world of false prices. It punished savers, fueled massive bubbles in stocks and real estate, and taught every investor a dangerous lesson. The Fed put was ironclad. Any major downturn would be met with more bailouts, more money creation. The risky behavior that caused the crisis was not punished, it was incentivized. The emergency medicine became a permanent addiction. Parallel to today, an acceleration phase, modern footage of consumers using credit cards. Data visuals showing spikes in auto loan, credit card debt, and national debt surpassing $36 trillion. Today, the unresolved legacy is everywhere. In the 2000s, risk was concentrated in subprime mortgages. Today, it is systemic. Household debt is at a record high, with credit card and auto loan delinquencies rising sharply. But the most dangerous transformation is in sovereign debt. The U.S. national debt has quadrupled since the crisis. The government now spends more on interest payments than on national defense. The entity that stepped in as the savior in 2008 is now itself the world's largest debtor. Meanwhile, the tools are broken. To fight the inflation unleashed by years of easy money, central banks must raise rates. But doing so threatens to destabilize the very debt-saturated system they built. Each rate hike increases the risk of a new, more complex rupture knot in housing. But in commercial real estate, shadow banking, or the treasury market itself, the system is accelerating toward a paradox it cannot solve. Climax, revelation, and ending slow. Evocative shots of empty office buildings, Federal Reserve Building, and a final montage linking 1929, 2008, and present-day visuals. So what is the big truth we must understand? The crisis never ended because its root cause, a system reliant on limitless debt expansion, was never addressed. It was institutionalized. We replaced the gold standard with a faith standard, and in 2008, that faith shattered. The response was not to rebuild on solid ground, but to double down on the faith, demanding we believe in ever greater amounts of currency created from nothing. We now live in a trapped system. Faced with economic pain, authorities must choose between triggering a deflationary debt collapse or unleashing more inflationary money creation. A cycle that erodes the very trust the system requires to function. Final reflection. A single still shot of a closed bank vault door. Asterisk, asterisk. The question is no longer asterisk, if asterisk the perpetual crisis will demand its reckoning, but asterisk, when asterisk, and what will remain standing after the inevitable adjustment comes.